go ahead and get started. Today is Wednesday, September 28th. This section is being recorded for being posted on YouTube later today. This is section 401. This is the attendance sheet. Make sure you sign it saying that you were here before you leave. I'm going to start it out on this side of the room. Pass it around. So today we're going to be covering basically the content you need to complete homework 5, which is due Monday. Starts the second section of our class. We just wrapped up EIC. Again, half the performance of any company or business is the external environment. So we gave you a framework to understand and explain the external environment and its changes over time. Okay? And we just did a group projects on that. Right? And that's going to be important when we get to valuation. Now we're going to move into the next stage, which is called historical analysis. Right? Now, here's the thing. I like to say you can't drive a car looking in the rearview mirror. We got to be careful because the history doesn't guarantee the future. Okay? So even though we look a lot at the past to help us understand the future, it doesn't mean it always repeats itself. And so the future is more important. In fact, I'll also like to say it's the big difference between accounting and finance. Accountants look backwards. As finance people, we have to look forward. Okay? Because I care much more about the cash flows you will generate than the cash flows you have generated. Okay? So back to the valuation, when we get to valuation, it's about what we do in the future. But in order to prepare for that, two things. One, we're going to go through this section because it's going to help us get a better understanding of the current situation of the business before we forecast the future. And two, we're going to put things into a format that will make it a cleaner valuation of the future. Okay? And that's really what we're going to do. We'll go through the historical section for companies. Right? So the first part of this is putting statements into a format that is better suited for valuation, analysis, and forecasting. Okay? And so that's where lecture note 3 comes in and the readings you did in the book for this week. So, McKinsey is tied to essentially Modigliani-Miller. And this is a graphical representation of Modigliani-Miller. And what it says is a company is worth the sum of its future cash flows, but as we talked about in a previous class, we're going to break those cash flows into operating and non-operating categories or buckets, okay? As opposed to looking at the average cash flow of everything that a company does. Okay? Now, in this class, the operating cash flows, as I said earlier, are generally things that support sales on a recurring basis. So if I'm selling products and services to customers, how much am I making on those sales, and what am I investing to basically enable those sales to happen? Okay, so if I have a manufacturing plant that's making products, that's operating. Okay, if I have inventory that I'm selling to somebody, that's operating. If I'm generating sales from customers and services paying me for my goods and services, that's operating. Okay, but we're also going to break out the cash flows into non-operating. So if I'm a Silicon Valley company and I own land in Montana that I start herding cattle and selling cattle farmers the ability to graze my land, okay, that may not have anything to do with selling the products or services that I do, but it generates revenue for me. That would be a non-operating cash flow. Or if I'm Apple and I got $200 billion of cash sitting in the bank, not doing anything but earning interest, has nothing to do with selling the next iPhone, that's a non-operating cash flow. Okay? So we're going to value those separately. Okay? And we're going to take the operating and non-operating cash flows, we're going to add them together, and that's going to be called enterprise value, or EV, the overall value of the firm. Okay? Now, to help you, we're going to introduce a mnemonic that doesn't exist anywhere in the book or real world that will only help you in this class, but I found it helps people understand this new language that you have to learn very quickly. We're going to call operating cash flows ones. We're going to call non-operating cash flows twos. Okay? So that when you add the 1 and the 2's together, you get something called enterprise value. Okay? So it's your operating, non-operating cash flows. Now that enterprise value is the cash that you can pay out to the investors. And you're going to have 2 investors. You're going to have debt holders and you're going to have shareholders. Okay? So the debt holders are going to be called 3's, and the equity holders we're going to call 4's. So 1 plus 2 equals 3 plus 4. General idea, if I have $500 million of cash I make from running my operations, I have $500 million I can distribute to the debt and the equity holders. They will always be equal. Okay? If I have a $500,000 house, I need $500,000 worth of financing. If I have a $300,000 house, I only need $300,000 worth of financing. These two sides are equal. That's part of the Modigliani-Miller process as well. So operating plus non-operating cash flows equals debt plus equity cash flows. They both sum to what we call enterprise value, or EV for short. Questions about any of that? Great. Here's the rub. The accountants don't put financial statements that they produce into this format. So this is what you're going to hate, but what we're going to do is we got to rearrange the accounting statements to this format. Okay, that's where the 1, 2, 3, 4 classification will help you. So this is the point. It's a 3-step process. Step 1, we start with the accounting statements, income statements, balance sheets. Step 2, we rearrange them to the economic statements that tie to Modigliani-Miller's format. Step 3, we forecast them and do valuation. Okay? This is the process McKinsey uses in the book. It's a better process. Here's the thing. What you've learned heretofore and what most people do is they skip the middle step. They go directly from the accounting statements to the forecasted cash flows. I'm not saying you can't skip the middle step. You can do that. But I'm going to tell you there's 2 advantages to this middle step. Number 1, you're going to get a cleaner understanding of the business and the forecasting when you do the middle step and forecast based on economic statements. And number 2 is going to make the analysis much more straightforward. Okay? So you're going to hate this process, but then you're going to like the process. Okay? You just have to get over the hump. It's like learning a new language. Okay? So it's not better or worse. I think it actually is better. It's just different than what a lot of people do, because most people skip the middle step. They'll go straight from this accounting statements straight to forecasting the cash flows. Right? So when we go through this process, we're going to start on the left side of the screen. It doesn't matter which statement you convert first. The income statement or balance sheet both have to be converted to create statement number 3, which is the cash flow statement. Okay? Cash flow is income statement minus change in balance sheet. That's generically how you create a cash flow. So you need both the income statement and the balance sheet converted to do the third statement. So again, it doesn't matter which of the first 2 you do first. You got to do them both to create the third. And then once you create the third, we can then forecast the cash flow to get the valuation. Okay? So back to our 1, 2, 3, 4 process. Starting out with the income statement. Anything that is operating, all right, we put together off of the income statement. All right? When we net all those operating items off the income statement together, what we're going to call all of our ones, that's going to give us our NOPLAT, or the operating profit after tax. We're going to then take all the non-operating profit items for the income statement. We're going to net those together. That's going to get us our non-operating income over here. When we add these 2 together, our operating plus non-operating, NOPLAT plus non-operating income, we're going to get something called TII, total income available to investors. Okay? That's the total profit from the operating and non-operating activities. Now, these statements have to balance. Okay? So if I make $100 million of profit, I have $100 million that I can distribute. So the other side of the statement that we're going to balance is called the funds flow or financing side of the statement. And so it's going to equal the profit that we generated. So on the other side of the statement, we're going to take all the payments to the debt holders, and we're going to put them on there, the 3s. And then we're going to take all the payments to the shareholders, 4s, and we're going to put them there. The 3s plus the 4s are going to also equal the total income available to investors. Because if I have $100 million of profit, then I have $100 million to chop up between my debt and my shareholders. The 2 sides of these statements must equal. That's the other thing about this class. We will do balancing statements. An unbalanced statement in this class is an incorrect answer. I don't care how many hours you work and how close you are. If it doesn't balance, you're getting a 0. You won't get credit on any assignment. I'm doing it for your benefit. This is the other difference between this class and other classes, and to some degree the real world. Because let's say you're getting your dream job at JP Morgan, and you're working as a junior analyst, and you're calculating free cash flow, okay? And you don't balance that calculation, you just stop once you do free cash flow. And you forgot to put change in inventory into that free cash flow number. You will not know that you made a mistake in your free cash flow calculation because you don't have to balance it against anything. In this class, if you forget to put inventory in your free cash flow calculation, it will not equal the financing flows, and you will know that you made a mistake somewhere, okay? So a balanced statement mitigates mistakes because you have to balance the statement, all right? And so that's why I use the analogy of Legos. What we're gonna do is we're gonna take a Lego toy, we're gonna rip it apart, and we're gonna put all the Legos into something else. When we're done, there can't be any Lego blocks on the floor. If there are, we made a mistake, because otherwise the statement won't balance when we put it back together. That is true for all of the statements. You're gonna hate that. Some of you are gonna fail some assignments because of that. But that which does not kill you will make you stronger, and it will make you better at what you do, because no one else forces you to do this, I do. Now, whether you do this after the class is up to you, but I will tell you, most of the students that go on to work on Wall Street still balance statements to this day, and they thank me for being a hard ass on them, because it makes them better at what they do. It mitigates mistakes, and it makes sure that you put things in the right place, okay? So, regardless, it's gonna be the way we grade you. So, second statement, balance sheet, same process. We're going to take all of the assets and liabilities that are operating, we're going to net them together, and that's going to be called invested capitals. So that's all of our balance sheet ones. Then we're going to take all of the assets and liabilities that are non-operating, and we're going to net them together. And that's going to be called our non-operating capital. Operating plus non-operating capital is going to be called TFI. So the rearranged balance sheet, total funds invested. That investment is going to be financed long-term by the interest-bearing debt, the 3s, and the equities, the 4s. Okay, that's the balance sheet rearranged, called TFI. All right. Now, note that this is not an Investopedia statement, because, for example, when we look at current assets minus current liabilities, we're going to go line by line in the current assets and say operating and non-operating, and we calculate working capital, like you did in your custom assignment for our operating ROIC. We're only going to look at the operating items of working capital when we calculate our operating working capital. So it's not just current assets minus current liabilities. In fact, in current liabilities, they can often have short-term debt. Short-term debt is interest-bearing, which means we're going to take it out of that and call it a 3. We're going to call it a debt item on our rearranged statements. Okay, so some of the things that you learned in accounting will not apply here when we do valuations, particularly tying into the Modigliani-Miller format McKinsey uses. Right? So that's going to be the first two statements we're about to convert. Once we do that, we'll create statement number 3, which is called the cash flow statement, or CFI, cash flow available to investors. All of the operating cash flows, which is the NOPLAT from the income statement, minus the change in the operating invested capital in the balance sheet, is going to be called free cash flow. And that is the operating cash flow of the business. We're going to take the non-operating profit from the income statement plus the change in the non-operating capital in the balance sheet, and that's going to be our non-operating cash flows. We're going to add those two together, and that's going to be called CFI, the cash flow available to pay out to the investors. That is going to equal all of the payments to the debt and equity holders, which means if I take all of the interest that I pay on the income statement and any change in debt in the balance sheet, that's going to be my cash flow to my debt holders. If I take the dividends that I pay to my shareholders, change in equity out the balance sheet, that is the cash flow that is going to the shareholders. 1 plus 2, free cash flow plus non-operating cash flow, equals 3 plus 4, debt cash flow plus equity cash flow. Clean lines, Modigliani-Miller. Our final step, which we go from this section to the next, is we're then going to forecast all of this. We'll forecast the free cash flows, operating value. We'll forecast the non-operating cash flows, non-operating value. Add the two together, enterprise value. We can also forecast the debt and the equity cash flows to get the debt and equity value, which also equals the equity value. We can go across, we can go up and down. I could actually forecast TII and TFI directly to get CFI, and then forecast CFI to get enterprise value. Okay? So I can work across, I can go up and down. One of the other benefits when we put it in this format is operating ROIC. What is operating ROIC? No plat divided by operating invested capital. We have it now cleanly separated out, real easy to do an ROIC in a company in the rearrange format. Okay? So to do all of this, we have to rearrange, but this is the process that we're about to learn and go through. Questions about any of this so far? So again, in the previous class, we talked about this when you created your custom operating ROIC. Okay? And again, I want to come back to this, now that I've kind of introduced the concept, you've read the book, about what is different here than you might see in Bloomberg or in one of your other academic classes, right? Here's what's different. When Bloomberg or the rest of the academic world calculates ROIC, what they're doing is they're taking the overall profit from the business after tax, and they're dividing it by what they call the invested capital, the debt and equity of the firm. They're not separating out operating and non-operating. Okay? What that actually represents in Modigliani-Miller format is what Bloomberg calls ROIC is actually TII divided by TFI, or the equivalent of a CFI. Okay? So it's not the operating and non-operating broken out, it's an average ROIC. Okay? It's a return on the average investment in the assets of the firm. That's what the rest of the world calculates for ROIC. What we're going to do differently is we're going to have an ROIC on the operations, operating ROIC, and then we're going to have a non-operating ROIC. And if you average them out, it's the average ROIC that Bloomberg reports, which is the average ROIC of the business. And you might say, well, why does this matter? Well, I'll go back to Apple. If Apple makes 400% when they sell an iPhone, and they make 4% when they keep their money in short-term cash, and they average out to 52% as a business, then every time they sell an iPhone, they don't make 50%. That's what we would be forecasting. And that doesn't make sense because they're going to make 400% when they sell iPhones. They're not going to make 50%. That was the point of the operating versus the non-operating ROIC. All right. So when we did our custom formula, so for example, if I took a company like Merck, Big Pharma, and I did the RV on Merck, and I went to our custom formula for operating ROIC as a spread, I have three numbers that are going to pop up: the operating ROIC, the traditional Bloomberg average ROIC, and the WACC. What you'll see for a company like Merck is that there's not a huge difference between the operating ROIC and the average ROIC. Okay? So translation, if I'm forecasting Merck's pharmaceutical business in Bloomberg and I use 22.59 or 23% to basically forecast 23 cents a profit per dollar of investment, I'm not going to be that far off from them selling drugs making 25%, right, in terms of their business. So therefore, it doesn't matter as much for Merck. It matters, but not hugely. Versus if I were forecasting Google, better known as Alphabet these days, then their average ROIC is give it a second to load, 21%, but their operating ROIC is almost 53%. Because that's the point. When Google sells advertising services, AdWords, whatever, they're making 53 cents per dollar. They're not making 21 cents per dollar. Because like Apple, Google's got a bunch of cash sitting around in accounts overseas, earning very low interest. So when you average that out, it makes 21. But Google is really two businesses. Like Apple, they're a business selling AdWords that makes 53 cents on the dollar, and they're a business that has a bunch of cash lying in a bank making 4 cents on the dollar. And when you average it out, it's 21. But those two grow at different rates. And we will forecast them at different rates. And that's what makes our valuation better than what a lot of other people do that just forecast based on average. Okay? But in order to do all of this, we have to put these statements into this format. Again, questions about this? Make sense? Well, one of the questions that came up in the last class is, did I do this on Wall Street? And the answer is yes, but. And here's the thing. Most people use Bloomberg's ROIC because it's easy. It's there. It's laziness. You don't have to do anything. They calculate it for you. And it's pretty standardized. Okay? But here's the thing. Go to BRC, read an analyst report on a company which has their valuation from JP Morgan, Deutsche Bank, people we have access to. And when you read through their valuations, you'll see they forecast free cash flow. Right? In order to forecast free cash flow, you got to forecast an operating performance of a business. It's a pain to do a free cash flow, which is why a lot of people don't like to do it because it's hard. Right? ROIC is easy. So here's the point. They're doing it. They're just doing it with people like yourselves who are forced to go calculate it and explaining it because they got an apple and an orange there. What we're going to do in this class is we're going to have the operating ROIC, which is the free cash flow, and we're going to have both numbers. So they're kind of doing it indirectly. They just have the average ROIC and they have the free cash flow, and they're broken out. Because back to Modigliani-Miller, what they're doing, if you use the Bloomberg ROIC, is they're doing TII divided by TFI. That's how they get ROIC. We're doing no plat divided by invested capital, which is the direct relationship to free cash flow. So what they're forecasting is typically this and that. And that's not equal. What we're doing is a straight line across, right? But we're also going to not ignore the non-operating stuff because operating and non-operating average out to the overall return on investment. But by breaking it out into its two component parts, we can forecast them to grow at different rates. And that's going to be the most important part of what we do with our valuations. Okay, questions, comments? I guess I'll get this pretty straightforward. All right, so next, let us start converting these statements. All right. So the book goes through in this chapter a series of very simple income statements and balance sheets, and it shows you the accounting statement on the left and the converted statement on the right. This is the balance sheet. Okay, so you got the kind of current accounting, converted statements going through this process. So what I'm going to do, assuming that you kind of read the book, so you're going through these slides, is I'm going to switch to this Excel file, which if you're following along at home, watching this video, or you're in this class, you want to follow along, I put into the files folder a file called conversionvideostart.xls. Okay? So this is the Excel file, which basically loads the examples from the book so we can see what they did. We're going to kind of practice in class showing you how to do the conversion. Okay? Homework 5 is going to be some complicated statements that you're going to have to convert yourself for the next class, and that's also right here, which is also direct now linked, and that link is working in homework 5. Okay? But nonetheless, we're going to go through the examples they have in the book here so we understand the process. So this is the simple income statement and balance sheet that the book had. Here's the balance sheet, 2 years, current prior. Here's the current year income statement. Now, it doesn't matter, as I said, whether we do income statement or balance sheet first. I'm going to do the balance sheet first. What you're going to need to do is every statement should have its own tab. So I'm going to create a new tab, and I'm going to call this tab, rename it, TFI, or worksheet, and make it a little bit bigger so it's easier to see what I'm doing. All right? So then I start rearranging my balance sheet. Now, before I can rearrange my balance sheet into a 1, 2, 3, 4 Modigliani-Miller format, see where it says label? I have to label everything as 1, 2, 3, 4. Operating, non-operating, debt, or equity. Okay? So let's go through that process now. Cash. Is that an operating, non-operating asset? Is that a debt asset or debt liability? Or is that an equity liability? What is it? What do you think cash is? Yep.
I think it would be number 1 for operating.
You think cash is operating? Okay. So operating is recurringly necessary to sell more products. So when Apple has $190 billion in cash in the bank, is all that operating? Do they need to borrow another $190 billion to have $190 billion more cash to sell the next 300 billion of iPhones?
No, I suppose the excess cash would be non-operating, and then cash that's directly being used would be operating.
Okay,
So this would be non-operating?
so there's the good point. Cash is both operating and non-operating. It's kind of a trick question, right? Now, in the book, in this simple example, they call it operating, okay? So here's the point. My personal example. When I was 15 years old, I worked the Burger King drive-thru. Now, that was a long time ago, and technically you had to be 16 to work the Burger King drive-thru, but back then nobody cared. Okay? So when I worked the Burger King drive-thru, I would come in every day, and I'd go to the manager's office, and we'd have a little cash to put in the till. He'd put it out, we'd count it. And there was an exact amount of cash. It was either $80 or $120. I don't remember. This is like back in the 80s. But the long story short, we'd count the cash to make sure the right amount of cash, exactly the same every time I started my shift, was always in that register, because I was going to use that to make change as people went through the drive-thru. Didn't use as many credit cards back then. We then go to the register together. He would take out the till, put in mine, crank the register, which would reset it, print out a little piece of paper saying how much was in there, and then I'd run my shift. At the end of the shift, he'd come in with the next cash register, take mine out, crank the shift, print a piece of paper, go back to his office, we'd count the cash. Let's say it was 120, we'd leave 120 in, everything above 120 we would take out, right? Here's the point. They couldn't take out the $120 because they always needed to have the next person's ability to make change. Because if you can't make change, then they couldn't function. Particularly then we didn't have as many credit card purchases. So there is some cash that can never be paid out to a shareholder or a bondholder because it is actually necessary to run your business day to day, right? I have to make payroll every week, every 2 weeks as a company. I can't pay that cash to the bondholders, right? There are just things that I have to do, pay suppliers, pay employees, that even if I went bankrupt, I could never pay it out because even in a bankruptcy court, the judge would make sure the employees got paid before the banks got paid. So net debt is a fallacy. Net debt, which you learn in other classes, which is debt minus cash, because all the debt can go to the debt holders, that could never happen in the real world because some of that cash could never leave the business. So that's the point. The cash that you have to keep in the business to run it day to day is operating. All the cash above that is non-operating, which we will call excess cash. That is a distinction most people do not make, but we will, okay? And that's another key to the class. Now, I was a CFO for 18 months, for the last 18 months up until this class started again. And I can tell you, as if you go to any CFO or any treasurer, I knew how much cash we had to have on hand to run our business day to day. So you talk to a company, they know. They know I need this much cash on hand. All right. Now, we don't have that luxury. So what we're going to do is we're going to use an oversimplification that says 2% of revenue is operating cash, which is another way of saying everybody needs at least 1 week of cash on hand to run their business, right? Now, the actual amount may vary by industry or by company, and ideally, we'd like to find that out. But as a minimum, as we're doing valuations in this class, we're going to use the 2% of revenue rule as a starting point, okay? That's operating cash. Anything above that, excess or discretionary cash. That's a 2. Does everybody see the difference? Now, for purposes of the book at this point does not distinguish, and they just call all of that operating. Okay, but if technically, as you pointed out, some will be operating, some will be not operating, but right now they're just going to call it all operating, and we'll go with that simple example. Okay. Next item, inventory. We make a product that we're going to eventually sell to a customer. Is that an operating or a non-operating asset? Inventory. Operating, exactly. The building, land, and equipment we make that inventory in, called PP&E, is that operating or non-operating? Operating, because we're using it to make the product that we're going to sell. Recurring, 1. All of these are labeled 1. Equity investment. We own a stake in another business that we don't run. We're minority shareholders in somebody else's business. Is that an operating or a non-operating investment? Yeah. Non-operating. Has value, but we don't have controlling interest, and has nothing to do with what we sell, so therefore it's a non-operating investment. Ever see the difference? That's a 2. Total assets is a total. We don't do the totals. Accounts payable. We owe a supplier for materials that are probably in that inventory that we're going to pay them in 30 or 60 days. Is that operating liability? Is it a non-operating liability? Or is that a form of interest-bearing debt? 1, 2, or 3? We owe a supplier for material that we haven't yet paid them for. Yes?
3.
Why would it be a 3?
Anything you have to pay is not liability.
We know it's a liability. So here's the question. If I pay them in 30 days, do I owe them more money?
No.
So is it interest-bearing?
Oh, no.
3s are interest-bearing. So we know it's not an interest-bearing liability. So it's either operating or non-operating.
I would believe operating.
So it's an operating liability. It's actually a 1. Okay? But that's a really good point. We got to think through these things. That's the point about plugging and chugging. This doesn't work with plugging and chugging. You got to conceptually think, what is this? This item that's strangely labeled by some accountant, what the heck is it? And is it an operating item? Is it a debt item? We're going to eventually have to discern that stuff. But in this case, it's a 1. Okay? Now, interest-bearing debt that we owe the bondholders or the banks, is that an operating, a non-operating, or a debt liability? What is our interest-bearing debt? There's the clue. It's debt. That's your 3. Money I owe to the shareholders as retained earnings tied up in the business. Operating, non-operating, debt, or equity? Yep.
I would think equity.
Exactly. Retained earnings belong to the shareholders. It's an equity. Again, totals don't count. So in our very simple income statement, we've labeled the 1, 2, 3s, and 4s. Now again, you can skip over this process. You don't have to listen to me, all right? But here's why it should hopefully benefit you as you go to this next step. So now I want to put these numbers, which I just labeled, into the Modigliani-Miller format. So the first thing is I want to put all the operating items together, okay, to get my operating invested capital. So those are all my 1s. So what I'm going to do is on my second sheet equals the prior current label, so I can just copy the years over correctly. And I'm going to start with my 1s. My first 1 that I have labeled is cash. My second 1 that I have labeled as an asset is inventory. My third 1 that I have labeled is PP&E. My fourth 1 on the liability side is accounts payable. Those are the 4 1s. I can even count them, 1, 2, 3, 4. So when I copy and paste this over, those are my 4 1s. So what I then do to calculate my operating invested capital, and we'll probably just call it invested capital, but technically we're talking about operating invested capital, I net my 1s. I take all my assets and add them up, cash, inventory, PP&E, and I subtract my liabilities. And that leads me to $380 million of invested capital the prior year and $440 million in the current year. That's the funds that I have tied up on a recurring basis to run my operations. I then do the same thing with the 2s. I look for any non-operating assets and non-operating liabilities, of which in this example there's only 1, the equity investment. I take all my assets, net them against the liabilities. There are no liabilities at this point. And that gets me my non-operating capital, which I will write out. I'm being lazy, I gotta skip this step. But basically it's the 15 and the 25. That's my only non-operating item. So when I add my operating and non-operating capital together, TFI, total funds invested, that is the 380 plus the 15, or 395 of total funds invested, and 465 for the second year. So I know how much is invested, and I know how much is invested in operating invested activities, and how much is invested in non-operating activities. That's the first half of the TFI. Yes.
Sorry, you just went a little too fast for me. Where's the 380 from?
The 380 is the invested capital, which is the net of the operating items.
Okay,
The first three added and then subtract the liability.
thank you.
I actually applaud what she's doing. Ask questions now. Now's the time to ask them, not later when you're stuck at home wondering what the heck is going on. Yes?
So for equity investments, if there was more than one account for the non-operating, we would also like add all the assets.
Correct. Just like the assets, we'd list all the twos that were assets. And by the way, if there was a non-operating liability, we put that on there too, and we would subtract the non-operating liability just like we subtracted the accounts payable. Yes?
And so for the cash for our homework, you would do like 0.2 times this estimated revenue to understand the operating cash and then non-operating cash?
For your homework, no. What you're going to see when you open up the homework 5 file is it's going to say operating cash and excess cash. I've already done that.
Okay.
All right. I'm going to start with the training wheels on. I'm not going to try and trick you. I'm going to actually give you the labels, the 1, 2, 3, 4s, where you're not familiar with these statements, with the homework assignments, and to some degree the midterm that's coming up in 3 weeks. Because the midterm exam is just going to be, here's a bunch of statements, convert them. Okay? So that's going to basically be the midterm, and then analyze them. But here's the point. Shortly thereafter, we're going to go right to the real world, and you're going to see real world financial statements like a Dentsu, and you're going to be looking at Dentsu's income statement and balance sheet, and you're going to have to do this. So we're going to prepare ourselves for that process. Okay? So back to this. Other questions? All right, now let's go on to the financing side, the balancing side of the statement. 1 plus 2 has to equal to 3 plus 4. Now let's look for all of our debts, all of our 3s. So do I have any 3s? Yes, I do. I have debt. Debt is my 3. Okay, and then do I have 4s? Yes, I do. Retained earnings is my 4s. So I have my 3s and my 4s. Okay, those are only 1 3 and 1 4. I put them both on the other side of the statement. That's called the financing or the funds flow side of the statement. Yes?
Can you really quickly explain how that TFI again?
Can I do what?
Really quickly explain the formula for TFI.
So TFI, let's see here, is the invested capital plus the non-operating capital. Add them together. It's the 1s plus all the 2s, all the netted 1s and all the netted 2s added together. Just going back to here. TFI, invested capital, non-operating capital added together. Okay. So that's the point. Has to equal, you see on that tab, has to equal the debt and the equity added together. So that's the point. I got my debt, I got my equity, I add them together. Debt plus equity, 395 and 465. This is what I mean by balancing statements. And I'm pretty sure that I have the right balance sheet balancing in the areas because those match up. All right? Because here's a mistake you could have made. I'll shrink this down a little bit just to show you the mistake. So I'm doing my invested capital, so I'm trying to calculate an ROIC. It's late at night, and I forget to put accounts payable on there. So I just have the assets. I forgot to put the liability on there. Okay? Now look at my TFI. 520, 395. Doesn't balance. All right? First part, if I didn't try to balance it, I wouldn't know that 520 was wrong. That was the point I made earlier. Now that I balance it, I know that something is wrong because they don't balance. This is what I mean by I'm going to give you 0 credit, because you can't tell me whether 520 or 395 is the answer. You can tell me with a 50-50 probability that you hope you guess right, but you can't tell me with certainty that you know you're right because you got 2 different numbers. The only way that I know that you're right is when you have 395 and 395. Now I know that 395 is the right answer because you've shown me that it matches. This is what you're going to hate me for, because many of you are going to get a lot of points taken off because you'll have an unbalanced statement you can't figure out how to balance. That's why I'm giving you the steps with the labels, because what's going to happen when it's late at night and you're trying to figure this out and you forget to put accounts payable on here as an example, what's going to happen is if you count labels, 1, 2, 3 ones. Do I have 3 ones? 1, 2, 3, 4 ones. I probably forgot a 1. All right, that will help you when you start trying to figure out the missing items on your statement, because it will tell you you're missing something from a statement, which means it's probably the reason why it's not balancing. So labeling helps, but if you don't want to do it and you want to go straight to the statements because you're just super geek, go for it. All right, because we're going to grade you on final answers, but nonetheless, I think the process will actually help you. All right, so that is the balance sheet. We're going to do the exact same process for the income statement. So that's going to be another Excel worksheet. So new tab, TII for total income available to investors. Now we're going to rearrange, convert, and balance the income statement. Same idea, equals the years, prior, current, and label. Okay. And so I'm going to start with the same concept. What are all of the operating items on the income statement? Okay, so we go back to our income statement, and we have to label our income statement. So this was the example in the book, simple income statement, from revenue to net income. Okay, so back to 1, 2, 3, 4. Is revenue operating, non-operating, debt, or equity? 1, 2, 3, or 4? What do you think? Yeah, it's a 1. Yeah, it's usually operating. Customers are paying me for my products and services. That's typically considered operating. Operating costs. There's a big hint. 1s. Depreciation. Operating, non-operating, debt, or equity. You got a 4, you got a 1. Are you going to put up some other fingers to try and guess? Is that raising your hand? Okay. Okay. So you're saying it's a 1? Why do you think it's a 1?
How you calculate your operating profit.
Okay.
So I figured that it's operating as well.
Okay. That's one hint. I'll give you another one. The item on the income statement should generally sync up with the way you labeled it on the balance sheet. Where in the balance sheet does depreciation come from? What's driving depreciation in the balance sheet? Yeah.
Net PPE.
And we call that operating on the balance sheet. So therefore, the spreading that cost out over time in the income statement should also be operating. They should always be in sync. Okay, so he's right. It's a 1. It's operating. What about, again, depreciation is just a sum, so we're going to skip that one. What about the next one? Interest expense. What's that one? Operating, non-operating. Debt, equity. What do you think interest expense is? Paying interest on the debt. Yeah. 3, because it comes from the debt. Equity income. Operating, non-operating, debt, equity. And again, I'll give you a clue. Where on the balance sheet does equity income come from? Yeah.
Equity investments.
And equity investments are,
That's it.
so therefore the equity income should be 2. If I'm getting income from something that I don't really manage, that doesn't have anything directly associated with my revenue, then that's probably a non-operating asset. So therefore it's a non-operating cash flow, 2. All right. Profit before tax is a sum. Next item is tax. I'll give you a hint. It's actually all of them. We're going to break out the impact of taxes into each of the 3 areas. So 1, a 2, and a 3. What about net income? Is that an operating, non-operating, debt, or equity cash flow? Net income. Who's that go to? Yeah. Net income is a result of everything, but that income actually belongs to somebody. So who's it belong to? Yeah. Therefore, it's a 4. Because the shareholders get that just like the banks get the interest. That's what you could theoretically give the shareholders. Okay? Now, common dividends. Who gets those? That's a 4 as well. Shareholders. But here's the point. When you do TII, total income available to investors, dividends are not part of the income statement. So don't put the dividend onto the income statement. It will never balance. Okay? Dividends are off the cash flow statement. Okay? Now, we will need the dividends to figure out the cash flow, which is why they're actually on this sheet. But they're not part of the TII. So TII stops at net income. Remember that when you do your TIIs. Okay? So, back to rearranging. I've rearranged it. I don't like some shortcuts, but here's one I'm going to allow you to take. Okay? Operating profit is just that. It's all the operating items above it summed. So rather than write 3 items on there and net them to get to an operating profit, you can start at operating profit when you do your rearranged statement. Let's make your life a little bit easier. Okay? I'm not going to trick you before the midterm. Right? And I say that because you're like, well, when might I be tricked? And because some crazy accountant out in the real world decided to put a non-operating item in operating profit, we have to be on the lookout for that. Because under generally accepted accounting principles, there is discretion, and that's the problem. Okay? We don't have a common set of looking at everything consistently every time. And so we've got to be very careful that operating items are truly operating. Right? But back to that, operating profit, and the exams I'm going to give you will really be operating. Okay? So back to this. When I go to my TII, my first operating item for the operating is my operating profit. $280 million. Only 1 year of the current. Now, here's where taxes come into play. If I were a clean company and I didn't have any debt and I had $280 million of income, I would have to pay tax on the operating profit. And my $280 million times my tax rate, and my tax rate is 25%, I would pay $70 million in taxes. Those would be my operating taxes on my operating profit, $70 million. Okay? And I know I'm paying $70 million in taxes because my tax rate, taxes paid divided by my profit before tax, is 25%. Okay? So back to this. My NOPLAT is my operating profit minus the taxes, $210 million. That's my NOPLAT. That's your operating profit after tax. That's my operating cash flow from the income statement. Then I do the same for my twos. I take my non-operating items, of which there is just one, equity income, $4 million. That's my only two. I then pay tax on the equity income. Again, $4 million times a 25% tax rate, I'd pay $1 million in taxes. That is a non-operating tax, which gets me my after-tax equity income of 4 minus 1, or $3 million. So again, the people in the book, at McKinsey, when they wrote the book, were lazy. Because they just put a 4 on one side of the page and a 3 on the other. You're probably like, well, how do they go from 4 to 3? And the answer is because they took out the $1 million for taxes, but they're so good at doing this every day, it's intuitive to them that it's the after-tax number on the statement, right? I like to actually write these things out as I'm learning these statements to make sure that I actually understand what's going on. So it's the pre-tax item, tax-adjusted, after-tax cash flow. That's what's actually on these rearranged statements. So we're putting the tax with the item. If I have any other non-operating items of the income statement, I'd list them. I would tax affect them if necessary. And I'd add them all up. Now there's only one. And then I would have my after-tax non-operating profit. Now in this case, it's still the same $3 million because it's the only one. Just write that out. You could have skipped this step. But if I add them together, my total income available to investors is the $210 million of operating profit plus the $3 million in non-operating profit, or $213 million profit that I made that I can give to my investors, my debt and equity holders. Questions about any of that? All right. So here's the other thing. Yes.
So the after-tax non-operating profit is clear, but if there was other twos, you're saying it wouldn't be added?
Correct. If there are other twos, we have to put them on there, tax affect them if necessary, and then add up all the twos after tax. All right. Which, by the way, will be something you'll have to do in homework 5. There'll be more than 1 2. Yes.
Will you ever be subtracting on the TII?
Well, you could be subtracting. Let's say the after-tax income was a loss. So if I lost $3 million running another business, then I'd have to subtract my negative $3 million from the 210. My answer would be 207. So absolutely. Because the whole point of TII, think about the name, it's the total income from the investments that I've made, the TII, right, that I can pay to the investors, right, because that's the money that I can give to you that owns the company. And it's coming from 2 sources, by operating and non-operating. So if one of those sources is losing money, I can't give that to you, so the negatives will subtract from the money that will be available to pay out. Yes?
Can you explain the after-tax non-operating profit?
So that's the point. If you report $4 million of equity income and you're a U.S. company, the government's going to come looking for a tax on that $4 million of reported income. And if you're paying 25% tax rate, they're going to want 25% of the $4 million. So that's the million. Okay? So what you're getting to the investors is the profit after tax. It's the $4 million pre-tax I made minus the $1 million I gave to the IRS. I have $3 million that I can give to you. That's
So
the net.
is the after-tax equity income always going to be equal to the after-tax non-operating profit?
No, this is only in there because there's only one non-operating item on this very, very simple statement. And that's what I was just answering her question with, which is on your homework 5, there might be more than one non-operating item on an income statement. So if there are, you would have to add them together to get your overall non-operating income. That's why I put the extra line on there. Otherwise, this is just the Department of Redundancy department, okay? Because there's only one item, and I'm just being redundant here, but I'm putting it in there because one item is just this very simple statement. We may end up with more complex statements, hint, hint, to your homework and midterm exam. Yes?
So you would have to take tax off of all of those accounts?
Correct. If they're tax affected. Be careful, because if you have, I'll make something up, an extraordinary item, which is the last line on the income statement listed after the taxes are paid, then that's a hint that that item might already have been tax affected when it showed on the income statement, and you don't want to double tax count that. So this goes back to the accounting side. So pre-tax items, we tax affect. After-tax items, which are posted on an income statement directly, we don't want to tax affect, because then we'd be double taxing them. The rule, if the accounts are generally following it, if the item is above profit before tax, it's probably pre-tax. If it's listed after profit before tax and after the tax line, then it's probably an after-tax item. Okay? And then you don't have the tax affected. That's just a simple rule to follow. All right, so here's the point. I know the statements had to balance. So assuming I'm right, this other side of the statement, the financing side to the debt and equities, I know it needs to be 213. Okay? Has to be exactly equal to 213. It can't be negative 213, because 213 and negative 213 don't balance. This isn't about absolute values. It has to be actual 213. And the reason I say that is because this is not GAAP accounting. This is Medina Miller world we're in now. So here's the point. On the financing fund flow side of the statement, a payout to an investor is a positive number. An inflow from an investor is a negative number. So here's the idea. I have $213 million to pay out. Therefore, how did I pay the $213 million to the debt and equity holders? A payment to the debt holder plus a payment to the shareholder has to equal 213. Payouts are going to be the positive numbers. If I were to be losing money, if I had negative $200 million of income, I would have to go fund the loss. I would have to borrow more money to fund the loss. So they'd have to give me money to fund that loss. An inflow into the business on the financing side of the statement is a negative number. Okay? So if I have a loss on TII, I have negative financing. If I have profit on TII, I have positive payments that can be made to the financing. Clear? All right, here's how this applies. I now go to the financing side. I go to my threes, my debts. Right? What debt do I have off the income statement? Well, off the income statement, my 3 is my interest expense. I'm paying $20 million to the bondholders for the debt that I have. Those are my 3s. Now, here's the point. Should that be a positive 20 or a negative 20? Given what I just said. Should this be positive or negative? Yeah.
It should be positive
Because?
because you're paying back the investors.
Yeah, because I'm paying back the investors, it's a positive 20 million. Now the format of my statement that the accountant gave me said negative 20, so what I have to do here is I have to flip the sign. This is why I continue to say you can't plug and chug in this class. You gotta think through what's actually happening. On this side of the statement, if it's a payout, it's a positive number, so it's positive 20 million. I'm giving the bondholders $20 million out of the 213. Okay? But here's the other point. I can tax deduct it. So there will be a tax shield or savings that I can write off. So if I report to the government 20 million of expense at a 25% tax rate, I save 5 million, and my after-tax interest expense is 15. Okay? Because here's the point. If you're an individual and you carry a credit card balance and you owe a lot of interest, you can't write that off for your taxes. But if you're a business owner and you have a credit card with a lot of interest, you can write off every penny of the interest expense as a cost of doing business. That is just tax policy. Better for worse, companies can write off debt, individuals can't. Right? So back to this. $20 million of corporate interest, government will subsidize 5 million of that at a 25% tax rate. Okay? And so they're effectively paying 15 million of after-tax interest. All right, so that's my 3s. Then it goes to my debt. From debt to equity, my 4s. I got 1 4. That is my net income. I add my 3s and 4s together. 15 million net to the debt holders plus 198 to the shareholders for net income. 3 plus 4. $213. So I now have a very clean statement. Save this. A little smaller. So I have 210 million of profit coming from operating activities, 3 million from non-operating activities, 213 to pay out. Of that, 15 went to the debt holders, 198 to the shareholders. That's how I chopped up the 213. That's the rearranged income statement. Questions? These 2 statements, relatively straightforward. I think most of you will do okay on this in the homework 5. The 3rd statement, CFI, gets a little bit more troublesome. Okay? This is the one you'll probably struggle more with. In order to do cash flow, you had to do these 2 statements first, and then you create the 3rd, which is called CFI, cash flow to investors. And my battery's about to die, so hold on, I gotta plug in. So here's the key to cash flow, which is cash flow is cash from the income statement minus change in the balance sheet. Okay? And so that is a process that we are about to repeat 4 times. Okay? So just be aware of this. To calculate cash flow, it's current year income minus 2 periods worth of balance sheet. That's why there is 2 balance sheets on here and 1 income statement. Because you need 2 balance sheets to do a change. Okay, so it's cash in the income statement minus change in the balance sheet. That's what we're going to do for the operating cash flows to get free cash flow. That's what we're going to do for the non-operating cash flows, the debt cash flows, and the equity cash flows. So we're going to repeat this process 4 times. Sorry, just trying to get my plug to work. Computer doesn't die. There it goes. All right. So we'll make this bigger just so you can see it. And again, CFI tab, the new tab, statement number 3, equals prior current label, copy over the years. All right, so let's start working on the operating cash flow. Cash from the income statement, that's our TII already rearranged. And our rearranged TII is the no plat. That's my operating profit from the income statement after tax, which is $210 million. Okay. Now, from the book, free cash flow has a specific definition. Gross cash flow minus gross investment. Gross cash flow is no plat plus depreciation. So I have to add back my non-cash depreciation to figure out the actual cash flow, because there's a non-cash item in that no plat. So my depreciation is 20. Now here's the thing. Since I'm adding back the 20, it says negative 20 on the statement, I need to flip the sign to positive 20 to get my gross cash flow, if I can spell this correctly, all sorts of keyboard problems today, flow, which is the 210 plus the 20, so 230 million of cash coming from the income statement after tax. That's called gross cash flow. Minus gross investment, which is the change in the balance sheet. So less gross investment capital G. How much am I putting back in the balance sheet? Can't type anything today. MENT. All right. I'm going to give you the formula over here. Okay, we'll talk more in the next class, but it's also in the book. What's the formula for gross investment? Gross investment equals the change in invested capital plus the current year depreciation. That's the shortcut. Okay? And for purposes of this homework assignment, you can use the shortcut. So how much are we reinvesting? Equals current year off the TFI, invested capital minus previous year's invested capital. So invested capital went from 380 to 440. So we're putting more money into the balance sheet, 60 more. Okay? Plus the 20 million in depreciation. Our gross investment went up by, am I doing that right? So again, what did I mess up on? Equals current minus previous plus current depreciation. There we go, 80. So we increased our gross investment in the balance sheet by 80 million, giving us operating free cash flow of 230 minus 80, 150 million. That's how much cash we made from the operations, 150 million in this period. Yes?
Sorry, can you highlight the gross investment? What's the formula?
TFI C7 minus B7 plus the cash flow C2, which is depreciation. That's a shortcut. Now, continuing on. Let's do non-operating cash flow. From the income statement, non-operating cash flow, TII. Non-operating profit was $3 million. And that was my non-operating cash flow. Okay. Then, from the balance sheet, change in non-operating investments. It was just the equity investment. My equity investment went from 15 to 25, so it went up by 10. That's a non-operating investment. So when I net those two together, it's going to get me my non-operating cash flow. And when I add that to the free cash flow, I'm eventually going to get to my CFI. The whole point of CFI is the cash available to pay to the investors, kind of like the total income to investors. It's just now it's all the cash flows. So here's the key. When we think about the items above, do they add to the cash that I can pay out to the investors? Or do they take away from the cash that I can pay out to the investors? That's the plus or the minus. So if I generate $150 million worth of cash profit from my business operating, is that adding to the amount I can pay out or subtracting the amount I can pay out? It's adding to it, therefore it's a positive number. If I make $3 million of non-operating profit from a subsidiary that I own, does that add to my cash that I can pay out to my debt and equity holders or take away? It adds. That's a positive number. If I spend $10 million to buy more of a non-operating asset, does that add to the cash that I can pay out or does that take away? It takes away. So that $10 million increase in non-operating assets or non-operating capital is probably the better word for that. Should be a negative. So I got $3 million non-operating profit. I put $10 million back buying more of another business. So my non-operating cash flow, 3 plus negative 10, is negative $7 million. Yes? The 10 is the difference in the non-operating capital. Off the TFI, it is the 15 of equity investments that went to 25. So it's the difference, 25 minus 15, I increased it by 10. But if I'm buying $10 million more equity investment, I'm writing checks to do it. It's reducing the cash available to pay out. So it's a negative to my CFI. So profit, investment, negative 7. Total CFI is the 150 of free cash flow from operations minus the 7 of non-operating cash flow. I have 143 to go to the debt and equity holders. Yes?
Where did the 150 come from?
This is the gross cash flow minus the gross investment, 230 minus the 80. All right, moving along in the interest of time, I need to balance out the debt and equity, so I know it's got to be 143. So, same process. From the debt holders, all my 3s. What did I give the debt holders off the income statement? TII. I gave them after-tax interest expense of 15. From the balance sheet, what is my change in debt? From the TFI, my debt went from 225 to 200. That means I paid off $25 million worth of debt. Following the principle, if I'm paying the money out to the debt holders, should that be a positive or negative number? Paying out. Payouts are positive. So I got to switch the sign from a negative 25 to a positive 25. That's my debt cash flows. 15 in interest, 25 in principal reduction. Equity cash flows. Trick number 1. Net income is not the cash flow that I'm actually giving to the shareholder. What is the cash distribution to the shareholder called? A dividend. On the CFI, It's dividends, not net income, because we don't necessarily pay out all of our net income as a dividend. So therefore, it equals the dividends. Since the dividends are a payout on this statement, they're a positive number. 103 million to the shareholders. Then it is the change in equity. Did I issue or pay off common shareholders, treasury stock? Well, my change in equity, my retained earnings went from, off the TFI, 170 to 265. So I increased my equity by 95 million. Since I'm bringing the equity into the firm for the shareholders, that's a negative. So I make that a negative. Then when I add up these four items, it's my other four, change in equity, it's the only equity I had, I should get, equals the sum, I should get 143. If I don't get 143, I made a mistake. So I clearly made a mistake. So maybe I put the equity in wrong and it shouldn't have been a negative 95, it should have been a positive 95. Nope. What mistake did I make? Again, in the interest of time, I'll help you. This is the tricky part, number 2 of the CFI. I did change in retained earnings on a cash flow statement. Is retained earnings a cash flow? Does change in retained earnings affect cash flow? No, it does not. So just like depreciation, a change in a non-cash item does not affect cash flow. So changing retained earnings has no impact on cash. So if you put change in retained earnings on your CFI will never balance. So you don't. And when you take that out, your statement balances. So 2 tricks to the cash flow statement. Number 1, on the TII, net income. On the CFI, dividends, not net income. And on the CFI, don't put change in retained earnings on the CFI. Okay? Because if you put CFI retained earnings change, it'll never balance. Those are the 2 things as you're doing homework 5 and beyond. Okay? This is balancing CFI. All right, real quick, statement number 4. It's called economic profit, or EP. It's also known as economic value added, but that is a trademark term by Stern Stewart, so you can't use it without paying them. So the generic term is called economic profit. Okay? EP is basically like a 1-year NPV for a firm. Okay? 2 methods for calculating it. Whether or not you're creating or destroying value in one period. That's all it is. So here's the idea. Copy over the years. Method number 1. What is my NOPLAT? What is my operating invested capital for my TFI? Because NOPLAT divided by invested capital is my ROIC. Now, for purposes of your homework, I'm going to ask for something called a BOY, which stands for beginning of year ROIC. Right? What that means, when you calculate your ROIC, you're going to take the current year NOPLAT and you're going to divide by the previous year's invested capital. 55%. That's your beginning of year ROIC. As opposed to end of year ROIC, which would be current year NOPLAT divided by current year invested capital. Okay? What you're then going to do is you're going to subtract your WACC. Let's say the WACC is 8%. I'll give you the WACC, and that's going to give you something called a spread. Spread is the ROIC minus the WACC. That is how much value you're creating or destroying on a percentage basis per year, 47%. We're beating our cost of capital by 47%. So economic profit, also known as EP, is the spread times the invested capital for the prior year we created $179.6 million worth of value. Okay? Because on $380 million worth of capital, we did 47% better than our cost of capital. That translates to $179.6 million of value created. That's called economic profit. Or method number 2, you take your no plat, which is 210 million, less what is called the capital charge. Okay? So here's the point. If I make 210 million of no plat, then I have 380 million worth of capital times my WACC. I got to earn 8% of that. I need to make 30.4 million to pay back 8% to my investors. I made 210, I pay back the 30.4. What is left? 210 minus 30.4. Is 179.6 million of value created. That's called economic profit. The first method is the spread method. The second method is the dollar method. Those are the balancing statements. Right? Yes?
What did we multiply the spread by to get the economic profit for the spread amount?
Economic profit equals spread times invested capital. Capital charge equals invested capital times WACC. These are the 4 statements. This is what you're going to have to balance for money. Yes?
What is capital charge?
Capital charge is right here. It's your invested capital times your WACC. I have 380 million tied up. I need to make 8% on that. It just puts a dollar value to the WACC. It's minimum profit to pay back the investors. Think of this as a 1-period NPV. Go ahead.
Invested capital times WACC.
Yes. The only difference is in this assignment, I'm going to ask you for a BOY invested capital, and a BOY ROIC, and a BOY economic profit, which means use last year's invested capital. Don't use the current year's invested capital. Right? And part of the reason, beyond being arbitrary, is that when companies, like say I'm going to build a plant that takes 18 months, I don't want to look at that plant that's in progress against the assets of the firm that are actually being sales and profits. So what I do is I look at the capital in place today, I exclude the work in process, and I get a better sense of how the business is really doing when that plant will actually be built. Okay? So that's why you might use the beginning of your invested capital. Okay? But regardless, it's what I'm required for your homework. Final thing as you run out the door, when you're doing your homework assignments for homework 5, it's going to look like this. It's going to have a lot more categories. It's going to look a lot more scary because there's a lot more categories on the income statement and on the balance sheet. However, all of them, 3 years worth of data too, but all of them have labels. So I'm giving you the labels for homework 5. You don't have to figure this out. You can follow the labeling. But nonetheless, follow the process that we did, create the 4 tabs. This is an individual assignment due next week. We'll cover it in class. TAs have office hours the next 2 days. Feel free to take advantage of them. See you guys on Monday. Have a good day.